In this video, we're exploring the challenges associated with forecasting. This is just one section in your book, but for the purposes of the video, I've broken it down into two parts so as not to make any single video too long and too tedious. So part two is coming up after this to complete the picture. Right. The challenges are basically a set of limitations and concerns, and we start off the limitation of using economic data from the from the past, basically, or even data from the present that are that serve as inputs into our most accurate, most recent, most up-to-date forecasts and projections. Here is a list of common issues that we're going to discuss, starting with time lags, something that we often do not think about, but any piece of economic data is going to pretty much have a lag, and that lag, which is built into it, will be due to, first of all, the need to collect the data. So collecting the data, that takes time. Processing the data, and finally getting it out, so disseminating the data, and the longer those time lags are, the more hesitant you should be, or the more wary you should be of using that data to give you a picture of the current state of the economy, because it's not really current. So there is, with those time lags going up, with the longer the time lags, the less that data is telling you about the current state of the economy, or there are more question marks about what it is actually telling you about the current economy, less and less. Then you have to bear in mind that most macroeconomic data releases, for example, are typically going to be revised after the initial release. So you get an initial release, and sometime later there will typically be a revision, an update to it. And this is a fact of life. So what's the big risk? The big risk is that when you then have access to the revised data, I'm going to write this down because it's important, using that revised data as if it were known at the time to which it applies. And let me just draw this out for you on a timeline. I think this could be one illustration that could help us a little bit. Let's say we're thinking about the end of the year, so this is 31st of December. A lot of data pertains to the state, or the state of the economy, the state of the market, etc., as at the 31st of December. And obviously the release of data that pertains to this date will come at some later date. So let's say this is the initial release. And of course, if the data comes with a bit of a surprise, the market will react upwards or downwards, depending on whether it's positive or negative news, or negative, let's say a negative surprise or a positive surprise. If it's not a surprise, in theory, the market shouldn't react. And the mistake would be, of course, here to use that data and assess what happened, for example, to the market on the 31st of December. The market going up or down on that date has nothing to do with this release, because we didn't know that data on the 31st of December. So if anything, you should be looking at the way the market reacted on the day the data was released. But then, if sometime later, at some later point, there is a revision to the data, you once again cannot use that revised data to assess what happened in terms of the market going up or down on the 31st of December, because on that date we had no clue about what the data would be, let alone the revised data, nor should we be using it to explain certain market phenomena on the date of the initial release. And the problem is, I mean, if you're standing over here, you probably know all of this stuff. But if you're an economist and analyst who's using this data and inputting it into a model several years later, or several decades later, you may not really be thinking of those things, and you may be coming to very false conclusions about the way the market reacts to certain releases of data if you're plugging in revised data and analyzing the response on the date of the initial release or the date to which that data pertains. Okay, hopefully that's quite logical. This is the risk of using revised data as if it were known at the time to which it applies or the date of the initial release. Right, then another limitation or another problem with using economic data, like macroeconomic data released by various sort of statistical offices, is that the definitions pertaining to that data, calculation methods also may just change. And once again, you're not getting coherent time series, are you? So, especially with calculation methods, the book talks about something called rebasing, which is done on indexes, as the book likes to call them. So, rebasing of an index. And this is not necessarily changing the constituents of the index, its fundamental properties, but changing the base period or the period used as the base of the index. So typically, you want the index computation to start off with a round number like 100 or 1,000, and then if the market is growing, then the index grows as well in line with the returns to the market. But periodically what happens with many indices is that they get rebased, so we once again go back to the round level of 1,000 or 100 or whatever, 10,000, and the big risk is you may not necessarily take that into account and therefore fall into the trap of mixing the data up from before and after the rebasing. Mixing data from before and after the rebasing, realistically speaking, you should be, if you're using data from before the rebasing, that data should retrospectively be also recalculated to conform to that new base. But often index providers, for example, only do this for the most recent 10 years and they leave the remainder of the historic data unchanged retrospectively. And as an analyst, you just have to take that into account. And it's not difficult, right, to do this, but you just have to be aware of it. It's a concern that you need to be cognizant of. Right, so that's the first challenge, limitations of using economic data. Then we've got a whole set of challenges, which the book describes as data measurement errors and biases. And once again, I've listed the common issues, the most typical problems that your book delves into. Starting with something very simple, so-called transcription errors, right? So these are errors in the processes of gathering data and recording it. And these could be, very sort of simple, common, call them stupid number errors, or something more, or something more serious. But think about this. Let's say we're doing a poll of I don't know, business people or a poll of employees, and we should theoretically be targeting the questions only to a specific group of employees, for example, falling into a certain age group, but the person doing the polling makes a mistake and asks somebody to respond to a questionnaire, but that somebody is outside of the target group. Maybe the target group is 30 to 40 years old, but that person is 28. So in theory, they shouldn't be asked at all. So that's a mistake in gathering data. And then, of course, if the numbers are recorded by hand with pen and on paper, it's easy to make an arithmetical mistake. To make just a recording mistake, or maybe somebody then is using the notes of the pollster to input them into a system, and they make a transcription error. They input something else, something different than what is written on the piece of paper. Easy, simple mistakes. Then something a bit more systematic or systemic here, survivorship bias, which you've heard at all levels already of the CFA curriculum. And this pertains to using data which only relates to the survivors, relates to those entities, be it companies or very often funds, especially hedge funds, which survived until the end of the period. And we know that this is especially problematic, or this bias is especially common in alternative assets, especially hedge funds, where a lot of the indices pertaining to hedge funds simply do not include information that on funds that have stopped existing, and it's typically the less well-performing funds, the underperforming funds that stop existing. So they paint just focusing on the survivors or having data on survivors only really paints a misleading, typically overly optimistic picture. Right. And finally, on this in this category of data measurement errors and biases, we've got appraisal or smoothed data. And this is going to be a problem, especially for the less liquid assets that do not trade in public liquid markets, assets without liquid, typically public markets. Although the need for them to be public isn't so important. I mean, a lot of fixed income doesn't trade in publicly available markets, but in liquid sort of broker-dealer markets. And a good example here would be real estate, which gets appraised systematically, like once a year, but whose value gets appraised by surveyors. Those appraised values tend to portray a smoothed picture. So this data tends to be simply less volatile than what would maybe happen if the assets were trading in a liquid market. And because of that lower volatility, you once again get a misleading picture. And this is something we already talked about at level 2. So I talked about at level 2 when we did alternative assets. That misleading picture has sort of two sides to it, or two consequences. You not only get lower volatility, or this impression of lower volatility, but also you get an impression of lower correlation with other asset classes. Other asset classes. You don't see the ups and downs that happen throughout the year, let's say, and you think, well, real estate isn't that well correlated with equities, for example. But that's because appraisals just produce data that is smoothed out. Okay. Then The next category here to explore is the limitation associated with, well, using historical data, so historical, making estimates based on history. And, this is, pretty much where this is going to go, I hope. This is nothing new from what you've studied in the past, within the CFA curriculum. Just a simple point that historical data may not be your best guide into the future is quite obvious. It may not be representative of the future. It may be, but doesn't have to be. But we often convince ourselves and kid ourselves that it should be business as usual, so history will get repeated. And there are some specific points here to be made. First of all, the need to look out for regime changes. These are changes in the historical record, in the governing set of relationships, or in terms of how the economy or how a certain industry works, for example. So changes in the sort of fundamental governing set of relationships in the economy or in society. I mean, think about how very much the world changed from before and after COVID. A lot of things didn't exist before COVID, and now they do. And it's very difficult to use data, combine data from before and after, and expect to get some meaningful trend, for example. So, and make a forecast using before and after data. So these regime changes, they result in what we call non-stationarity. And this is a concept you may remember from your level 2 studies of quantitative methods, regression analysis, and don't worry, we're not coming back with quantitative methods at level 3, but the concept should be familiar. Non-stationarity is when different segments or different parts of a data set have very much different statistical properties, like volatility, mean, statistical properties. And, look out for regime changes, but what do you do about them, once you've identified them? Well, the rule is that overall, you'll want to use, for your forecasting purposes, of course, as much data as you can. So the longest data set, or indeed part of a data set, for which stationarity can be reasonably assumed, for which the assumption of stationarity holds, can be reasonably assumed. So identify those breakpoints, those regime change points, and use as much of the data set as is available from the regime change that you can. Now, some interesting points, I think, about using data with a higher frequency. So this is, when I say higher frequency data. Okay, why is this drawing instead of shifting up? Now it's working. Okay. What we mean here by this is, for example, switching from monthly data to daily data, or from annual to monthly. So monthly versus annual versus daily data. As you go, let's say from monthly to daily, or from annual to monthly, so making the data more frequent, utilizing more frequent data, this should result in data which is more precise, or sorry, not data, estimates, forecasts. After all of these are challenges associated with making forecasts, projection, capital market expectations, as we said in the previous video. So this results in more precise estimation and forecasting, estimates. So that's good, of course, but only with regard to some of the properties, statistical properties that we want to assess or estimate. More precision in our estimation of the variance, the covariance, and if covariance, then of course also the correlation, because correlations are a function of covariances and standard deviations, so variances. So you'll get improvements here. Let me kind of try to illustrate that with a happy face here, but this is where I see an opportunity for a nice question, to test you on this. Please be aware that going from monthly to daily, for example, will not provide improvements, no improvement in the precision of the sample mean. So it's not the case that the benefits will be shared uniformly between the different properties or felt across the properties. Some properties you'll get better estimation of, others simply not. And that's important to bear in mind. And whilst it may seem that this is still, that this benefit alone is worth the hassle of getting daily data, which these days isn't that difficult, to get it online. Typically, you have to be aware of the fact that the more frequent the data you use, for example, daily data, you increase the risk of that data being asynchronous. Risk of data being asynchronous. And, this is the fact that if you've got two data sets, let's say you've got the Tokyo Stock Exchange, or three data sets, Tokyo Stock Exchange, Frankfurt Stock Exchange, or London Stock Exchange, and the New York Stock Exchange, and you want to measure what happens on all of these markets, the correlations between them, and for that purpose you use end of day, sort of closing market prices for each day. On a daily basis, the data you'll be getting from Tokyo will come from a different moment in time than the data from London or Frankfurt and the data from New York. So whilst you are, in theory, taking it for the same day and the same moment in time, end of trading, that end of trading falls on at different times across the globe. So let's write this down as an example, e.g. market. This is the most typical example that we typically give, market closing data from different time zones. With daily data, of course. And, whatever you calculate based on that will give you a distorted picture of, for example, correlations, because the world, when the New York Stock Exchange closes, might be in a very different state, and the investors globally might be in a different mood than they were when the Tokyo Stock Exchange was closing, or indeed the London Stock Exchange was closing. So this increased risk, it just distorts, especially our measured correlations, so covariances, and therefore correlations across, for example, markets. in theory, that risk of the data becoming asynchronous should be lower if you're using lower frequency data. So let me say less risk when using or with lower frequency data. For example, monthly data. But it's not completely eliminated, but still possible. And you know, here let's ignore stock exchange performance. But for example, if you've got data on things like employment or I don't know, sentiment indexes, etc., and you're using monthly data from across countries, and you think, okay, well, at least that should be synchronous. The fact that data for April is released in the US and in the UK, for example, doesn't mean that the data was necessarily collected at exactly the same time. Maybe in one market they do the exercise in mid-April, and in another country they do it at the very end of April, and they still release it as April data. But with the world being as volatile as it is recently, lots of things may change, may happen between the different dates on which people were asked, for example, about certain things. So that's something you have to bear in mind. Now, the final point here concerns a very sort of classic challenge or classic problem of historical data. Remember, we're on the point of limitations of historical estimates. Normal distribution versus fat tails and skewness. This takes us back very much to sort of level 1 quantitative methods, where we saw that actual data, actual economic data, especially in finance, exhibits fat tails, so higher probability of extreme outcomes, and skewness, so the data not being necessarily symmetrical. Whereas in a lot of the modeling that we do, for simplicity's sake, we often assume that the data is normally distributed when we make forecasts. So this is often assumed for the sake of simplicity, but in fact, the thing on the right is what we often find being exhibited by historical data. And we know this, nevertheless, we still make simplifying assumptions because it really is typically much easier to work with the assumption of normality in many of the applications, forecasting or projection applications. And finally, in this first part of the limitations, we're already almost half an hour into the video, so that you can see why I've broken this down into two parts, or took that decision, is the notion of ex post risk being a biased measure of ex ante risks, or the risk of that happening. Now, what do we mean by ex post risk versus ex ante risk? When you look at what happened to the actual market, let's say, you may sometimes discover very high or incredibly or unusually high, maybe, ex post returns, so returns measured on actual data, so after the fact, ex post. And the reason why those returns may be high is they may reflect a prolonged fear of some adverse event which finally did not happen, which did not materialize. And an example which I can materialize An example I can think of right now at the very top of my head is, I'm recording this in February 2026. And for a couple of months, or maybe several weeks, there was a fear that, an escalating fear of some kind of tension between the United States and Europe concerning Greenland. And there was a fear that there may even be military invasion. That kept markets in a state of fear, and therefore perhaps prices of various assets like equities were depressed. And when finally that fear, nothing is over yet, but that fear seems to have dissipated. It's kind of been moved aside because Donald Trump said he wouldn't, there wouldn't be any use of military force. At least that's the assumption right now. Prices shot up immediately on the day that was announced, or that statement was made. So ex post, the returns are incredible, right? When you think about what happened, but that's very much a function of a fear that existed, which went away. So using ex post data to project what will happen next is challenging, because the result is you will overestimate the potential future returns. So these are ex ante returns pertaining to the future, and underestimate ex ante risk. After all, nothing happened, but the fear was there, which caused when it dissipated, the incredible returns, and the risk really wasn't there. I mean, the risk didn't materialize. Also, in a similar vein, we may also, and this is kind of the flip side of the same argument almost, we may overestimate ex ante risk. So, our risk projections, if the data set that we're using, the historical data set, includes in it some rare event, like, for example, the 2008 collapse of Lehman Brothers, or perhaps COVID, or something like that, right? Those events are in theory rare, and if you're using a data set that also captures that period for your projections, you may overestimate the risk in your forecasts.